Welcome to the August update for the Hopkins Group Managed Discretionary Account. We had our investment committee meeting yesterday where we obviously talked about the portfolio and everything that's going on in markets. It's a really fascinating time in markets. We've got really mixed signals coming both from equities and the bond market, with equities, particularly in the US, I guess, with what's called the Magnificent Seven, the large technology companies that are bursting in price, and against the bond market, which is suggesting that interest rates are going higher and that the economy is going to slip into recession. So it's a really fascinating time in markets. And with that, we particularly with the international equities, we had a lot of discussion about the managers, because typically the managers are underweight the Magnificent Seven that we own, and the reason for that is that the valuations are really stretched, and they certainly from a fundamental point of view, it's difficult to see how the earnings are going to continue to grow at the rate that the market's subscribing to. So it just makes it really difficult period for an investment committee to choose what the right options are and do the right things. So and then as I said, you've got the bond market, which is suggesting that perhaps the economies are going to slow a lot faster than people expect, and that potentially that interest rates are going to stay higher with that slowing in the economy. So, it's a fascinating time to be on an investment committee, and we had some really robust discussions about, what's happening and how we're going to impact the portfolio. And I guess the big news this month was the fact that China announced significantly lower growth rates. We've had property markets in China that are obviously crumbling, and as some people would describe it, with Evergrande and those sort of companies that are potentially in trouble and into bankruptcy. So, that adds an extra layer of complexity. And of course, the China slowdown impacts the Australian dollar, which again, obviously has implications for investment selection and whether we hedge part of the portfolio or not against a rising dollar in time. So we did have a lot of robust discussions throughout the month, and certainly a lot of considerations. With regards to the portfolio, we didn't make any changes, but we certainly put a number of managers on watch. Felt that the performance and that their positioning around the markets currently is not sort of what we're looking for. So we've put them on watch, which basically means we'll keep an eye on them over the next 3 months to determine whether they stay in the portfolio or we'll replace them with a better manager, and certainly an option that sort of better reflects our view of where things are heading. And then also we had a lot of discussions around the hedging as well. And again, with the Australian dollar at 63 cents, it's getting to that time where we'd probably like to increase the hedging, but just sort of felt that maybe it was better to wait just to see how things played out, as I say, particularly with China and the interest rate differential with the US, which is the other key factor in the Australian dollar weakness, in that perhaps given the economic strength in the US, the bigger exposure to fixed rates, that they would increase their interest rates further than what we were going to do, particularly with the fixed rate cliff that's starting to roll off in Australia. Sort of the expectation is maybe that the interest rates here are going to stabilise, but there's potential for further rises in the US, which, as I say, would negatively impact the Aussie dollar. So all of those things are all going to the melting pot, but the reality is we're still sort of at that neutral stance that we've had, perhaps a little bit more defensive now than sort of we had been, just with the way the assets have appreciated and changed in value, but still that sort of neutral stance, because it's just really difficult to know, about the scenario and about how it's going to play out. And we just felt as an investment committee that it was better to not take a view of whether it's going to be strong or weak, that we'll maintain the asset allocations as they are, and then see how it evolves and make some decisions from there further. Certainly we're considering perhaps moving more of the portfolio in the fixed income component to fixed, so that's certainly something that's on the horizon. And as I mentioned, perhaps if there's any further weakness in the Aussie dollar, we'd probably increase the hedging from about 30% where it is currently to 50%, and maybe again if there's further weakness beyond there to sort of 70% hedging. But certainly that's nothing that we're doing at the minute, but certainly something that we're considering and looking at for the portfolio. So a really good month with regards to performance, and certainly obviously it's really happy with the way the portfolio is positioned, but there is really diverse views about where the market's heading and how things are going to play out. So maintain that sort of neutral stance and look forward to providing an update next month. Thank you for watching.